Thank you for our webinar today, Looking to Purchase a Dental Practice. Before we get started, I wanted to mention that there's a chat feature for this webinar, and you can ask your questions anytime during the presentation. We'll answer all the questions at the end of the webinar during the Q&A session, but feel free to ask questions via chat as you think of the questions. Our presenters are Matt Vanderloo and Laura Zach. Matt and Laura are CPAs and principals for SVA Dental Services. Matt specializes in providing dentists the financial support they need to start, grow, and transition their practices. Dentists looking to purchase a practice, Matt and Laura evaluate the various aspects of the practice, assist the potential owner with purchase price, cash flow, and tax considerations, and they guide the buyer throughout the process. And with that, we'll pass it over to Laura.
And hello, and thanks to all of you for joining us today. We have a lot of information to share with you in the next 25 minutes about the various topics we have on buying a practice, including the timing, factors to consider, understand the value of a practice, tax considerations, things employing the retiring dentist, and then due diligence. So let's get started. For a few years out of dental school, been working and getting great experience, building your skill set and patient base, getting the money to provide for a good life and pay back on your dental school loans. I'll come across the national statistics saying that the average dental practice has a profit of 40% of its revenue. And you're thinking, am I well as an associate? The question sits in the back of your mind. Is it time for me to consider buying a dental practice? Well, it's a big and personal decision, and one that Matt and I can't decide for you. But you should evaluate, are you operating at full efficiency from the clinical and productivity perspectives? Are you ready to take on the management responsibilities associated with being your own boss and owning your own clinic? And are you for the financial risk? There are many factors to consider once you decide it's time to start the process of looking for a practice to purchase. What community do you want to be in? Is the practice location convenient for you? Is it convenient for your patient base? Do you have to buy the building now or at a future date? What is the philosophy? And align with the selling dentist philosophy? Is it a growing area? What are the trends? Growing, shrinking, steady? Can you afford the practice price and get the financing needed? Is the right size for how much you want to work? There's much to think about here. Let's first discuss the main steps in the process of buying a dental practice. If you want to identify practices for sale, you might end up evaluating at least a few before finding the one that you think is the right fit. If you're interested in, you'll usually sign a confidentiality agreement before the seller will share any information with you. At some point, you'll sign a letter of intent stating your desire to look into purchasing the practice. A process line will be putting a value on the practice. Typically, it's the seller that prices, and be listed as a specific dollar amount or perhaps a value range. And due diligence process. This sharing and review of information so that you have enough details to decide whether this is the practice you want to buy and whether the price is appropriate. And negotiations. And much more than just negotiating on price. We need to consider allocations for tax purposes, payment terms, the time of the transition, whether you employ the retiring dentist or not, and whether he's going to work or she work beyond the sale date. And then finally, when the agreements are done and signed, the transition closes and you can take over. And close on a dental practice, what exactly is it that you're buying?
Great, and I think really we can what you're buying in that practice into two different categories. Really, there are two different types of assets you're purchasing. First category is the tangible assets. These are the assets within the practice that you might be able to touch and feel, or what we sometimes refer to as the hard assets of the practice, and all of the intangible assets, which we generally talk about that are the kind of the soft assets within the practice. So some examples of those tangible assets are going to be things like the accounts receivable in the practice. So what do dentists owe that practice for work that's already been done by the dentist in the practice? Supplies that have been purchased and are sitting on shelves and in cabinets in the practice. All equipment whether that's the actual dental equipment, the chairs and the cabinets in the operatories, or that's the computer equipment at the front desk, or all of the furniture in the lobby, but all of that equipment is usually part of the tangible assets of the practice. Improvements you might have in the practice, so if the practice rents its space and doesn't own its own building, it probably spends some money to build out the space it's in and to put in that reception desk and to put in cabinets and shelves and things like that. So those leasehold improvements would be part of the tangible assets. And depending on the practice might actually own the building and the real estate that it practices out of. So that would be another tangible asset in the practice. And then the building involved and real estate involved will suggest that that gets valued by a commercial real estate appraiser and not your whole higher CPA who's probably not an expert in real estate, but someone who is an expert and can really give you an accurate value on that. So tangible assets you'd see in a typical practice. The intangible assets then are everything, which is really going to be the goodwill of the practice, what we typically refer to it as. Some people might call it blue sky. Some people might put it in with a covenant not to compete. There's lots of different terms that cover it. Really, it's what the tangible asset is the right to earn income off of a block of patients in the future. That ability to see those patients on a regular basis, the ability to have a good introduction to those patients and to have all the records and information on those patients. Typically what we've seen in the last few years is this is a range of somewhere between 100% and 150% of year's net income from the practice before the compensation of the dentist in the practice. The comp would include everything paid out of the practice to the dentist, whether that's a base salary, bonuses, retirement plan contributions, benefits, continuing education. And we have seen typically that this goodwill number is trending higher and higher in the past 5 years as we have more and more buyers looking to buy practices, not just dentists looking to buy dental practices, but different types of corporate buyers looking to practices. And as more and more buyers competing over practices, people are getting more and more aggressive with their pricing of practices, which is driving this goodwill value higher and higher in recent years. So one of the first steps we talked about in the process of buying a practice is putting a price on the practice and determining what the value of the practice is. And at a level, there are really two ways we can look at doing this. We look at values as one whole, or look at all those different tangible and intangible assets and assign value to each of those, add all those numbers up to come up with one value based on all the parts that are in that practice. So looking at the value of it as a whole, how could we look at doing that?
What we have here is the whole and not the individual components, as you said, Matt. And really, price can be set based on a percentage of the practice top-line collections. For $1 million grossing practice might sell for 70% of collections or $700,000. That's one of those price points that we're seeing in today's marketplace. Part of the term rule of thumb, this is the concept. Price can also be determined by totaling the value of the various components of the practice. That is, items that Matt talked about. What is the value of the accounts receivable at the date that you purchased the practice? How much supplies is sitting in inventory for your dental equipment, some of your office supplies, etc. Plus, what is the value of the equipment? This might be valued by an appraiser or by a dental supply rep, or it might be an accounting of what was the price of it and how much of its use has been depreciated already. For that, there's the goodwill component, which, as Matt said, is often 100 to 150% of the doctor's compensation and benefits. Both the buyer and the seller must come to an agreement before this transition can happen. And there are various factors that will impact the price that you negotiate when you go to purchase the clinic. Those include the physical location of the practice. One is a really big one. Is the practice at the corner of Happy and Healthy? In other words, is it a Walgreens type location that has easy access and great visibility? Locate favorable lease terms, and sometimes option to buy the real estate may command a higher price at sale, as well as having a facility and equipment that is in good to great working condition. Relation is so important from the buyer's perspective. Think about it. Moving is expensive and disruptive to your practice and your people and its patients. And an older or outdated facility or equipment might mean that you have a potential costly upgrade in the future. That impact price would be doctor production and hygiene production ratios. I consider these like an X-ray, looking into the practice and seeing how much potential there may be or may not be in terms of improving productivity and efficiency. Also consider the current fee schedule. For example, a low fee schedule for the area might result in potential for upside for you as the new owner when you bring fees to market rates if you can collect more money when doing so. You need to consider whether or not you can perform all of the services currently provided. Or think endo work, the implants, the orthodontics, the extractions. You as the new owner and dentist be able to increase the practice's production and then potentially the profitability, end up decreasing the amount of work that you can do by needing to refer more out to specialists. Finally, as a purchaser, you will need to know about the payer mix of the practices, the insurance the current practice is contracted with. You as a business will want to have contracts with these payers so that the existing patients can continue their care with you as their new dentist. So let's say now that you and the seller have agreed to a price. And then the seller mentions that he or she wants to structure the transaction as a sale of the corporate stock. What does the buyer need to know about buying corporate stock?
They shouldn't do it. We've got buyer beware here for a good reason. That typically, as a buyer, buying the idea of corporate stock is not a good idea. We're going to talk a little bit more in a couple minutes here about tax considerations and allocation of purchase price, and this idea really relates back to that. So we're going to breeze through it a little bit here, but at a high level, when you buy a practice, we're going to take that price and assign it to all the different assets in the practice. And if you're buying all the separate assets, that works great. But if you're the other way you can acquire practice is to buy the stock of the practice. Just wanted to own any other business. If you wanted to be the sole owner of Apple, you get by going out there and buying all the outstanding shares of Apple that are out there. Probably tough to do with Apple, but can be something you can accomplish with a dental practice. So if you want to buy the practice down the street, you can buy all the assets, or you can buy all the common stock or all the LLC units of that practice, and that's in the same place. At the end of the day, either way, you own the practice. The problem with buying the corporate stock is that you don't get any tax deduction for the purchase price you're paying right now. You get a deduction someday in the future when you sell that stock, just like you would with any other stock you buy. But you're not going to get a deduction right now, even though that's buying that stock, you've really bought the equipment and the accounts receivable and the supplies of the practice. So it raises the acquisition price by much as up to 40%. Instead of paying $1 million for the practice, you have to pay $1.4 million because you've got to make $1.4 million, pay the tax on the $1.4 million to have $1 million left over to buy the practice. So it becomes a very expensive way to buy the practice. And as the new owner of that great corporation, you're liable for any problems that happen with that corporation at any time in its past. So there was some sort of sexual harassment issue or a wrongful termination issue or some unpaid tax bills in the past in that corporation. Those are now your problem as the new owner. And things that the attorney can do as you're buying the practice to help hold you harmless from any of those liabilities, but it's still not an ideal way to purchase the practice. So as the buyer, you want to look at only doing an asset purchase, and if the only seller is going to sell the practice as a stock sale, you want to at least strongly consider walking away from that sale and not buying that practice and finding another one that's going to be a better fit.
Too much risk.
Far too much risk for the buyer, yes. So don't corporate stock. So now that we've, as buyer and seller, we've come to some sort of an agreement over the price, the next big step in this process, we need to think about all the tax considerations with this deal. And we look at these kinds of deals, there are really three big tax considerations we need to take into consideration. We need to think about the allocation of the purchase price, the allocation of the purchase price, and the allocation of the purchase price. And it's important, it's our only three tax considerations there. And really, the allocation of the purchase price is what's going to drive the tax impact of the deal and how you're going to pay taxes as the new owner of the practice for the first few years you're the owner. The allocation of the purchase price is going to determine when you deduct the purchase price, drive the tax cost of the purchase, and it's really ultimately going to determine the cash flow from the practice for you as the new owner for the first few years. So we'll talk about the tax allocation. Let's just kind of give a pretty typical list that we see here, especially in Madison, Dane County markets and in the Milwaukee markets. A solo dentist practice that has $1 million of collections. They get $400,000 of compensation out of the practice, so 40% of their collections. And we do a sales price of $700,000, which is 70% of the gross collection. So as we're allocating that purchase price, one of the first keys you need to know is that buyers and sellers have very different goals in allocating the purchase price to different assets. So buyer might really want one allocation, and it'd be a great allocation for the buyer. The seller is going to have a totally different opinion of that allocation, is going to want something else done. So I've got an example here of how this might get aided. And as a buyer, you might take that $100,000 purchase price and say, I think there's $65,000 of collectible accounts receivable in this practice. And what I see on the shelves and in the cabinets, I think there's $25,000 of supplies in the practice. And like all this equipment, if I had to go out and buy it all and put it in a building to practice, it would be about $310,000 of equipment. And I use Goodwill of maybe $200,000 in this practice. And I also want to take $1,000 of that purchase price and allocate it to a consulting agreement for the dentist I'm buying this from, so that that dentist is around for the next year, the next 2 years, so that they can maybe fill in for me from time to time, and I can ask them questions about how to manage the practice and how to deal with patients and fun things like that. And all adds up to my $700,000 purchase price. That's allocation for the buyer, but the seller's going to look at the same $700,000 purchase price and probably want to allocate things in a very different way. They practice and they say, well, yeah, there's $65,000 of accounts receivable, but I think at best you're going to collect $50,000 of that. And there are a fair number of supplies in here, but you're vastly overestimating how much there really is and how much they're worth. And I really think there's only about $2,000 worth of supplies. And yeah, maybe it cost you $310,000 to buy all new equipment for this practice, but the reality is if I sell this equipment to anybody else, I'd be lucky to get $48,000 for it. And in mind, probably the real value in their practice is in the goodwill. It's great patient base they've built up, the great reputation they have in the community, the great name recognition they have. So they might think that their practice is really, the goodwill in their practice is really worth $600,000, which, based on the fact that they've got about $400,000 of compensation coming out, is pretty close, because that's 150% of their $400,000 of compensation. So we're vastly different in how the buyer and the seller want to allocate these. Between the different categories of assets, and they're both allocating the same dollar amount. They both have a $700,000 purchase price on the practice. Different in their allocations. The reason is because they get different tax treatment depending on what kind of asset it is and how it gets allocated. From a buyer's perspective, you're probably looking to get an immediate write-off or an immediate deduction for all of the dollars you're paying, or to get as quick a deduction as you can. So they're paying and allocating towards accounts receivable, supplies, and towards that consulting agreement. We're going to get to write off in our new practice immediately and get a tax deduction for them immediately. And the reason we want that tax deduction is because that deduction is going to free up cash flow in the practice that we're going to use to repay the bank for the loan we're going to get to buy this practice. We get to off over 3 years, 5 years, or 7 years. And then the goodwill, we get a deduction, but we have to spread it out over 15 years. So in that first 15 years we own the practice, we get the deduction for the goodwill. On that coin, though, the seller, receivable, supplies, equipment, consulting, all of the income, any dollars that get allocated to that part of the price, they have to pay as ordinary income, which means they're going to pay it income from that at the highest rate they have on their return. Every dollar that they can allocate towards goodwill, assuming they've owned their practice for more than a year, they're taxed as a long-term capital gain and get taxed at a much better tax rate. How much tax rate, Laura?
It's a 17% differential at today's current tax rate. So what this slide really shows us is it helps understand why this is such a big point from the seller's perspective and why you might see some push or negotiations on this when you are looking to buy a practice. So really that example Matt gave, we have a $400,000 difference in the amount assigned to the value of goodwill. At $400,000 and a tax rate of 17, or tax differential rate of 17%, that's tax savings of $68,000 to the seller. So it's pretty substantial. What we take away from this presentation is, as the buyer, you're going to want to understand how the negotiated goodwill amount affects your clinic cash flow and the timing of the tax deductions. Because I mentioned you're going to be spending cash to pay back your clinic purchase loans, and probably at a faster rate, then you can take the tax deductions for the goodwill. So this ends up being a bit of a cash flow pickle that you can get yourself into. So work with advisors to help find the sweet spot on this. And between that, the two examples that Matt laid out, the purchase allocations for the server versus the purchaser, often we see something in the middle, or it might depend too just on the laws of supply and demand for the practices. Hotter practices, multiple people might be competing for. You might see more allocation going towards goodwill because the seller essentially can command it with the practice that they're selling. Once the tax allocations are negotiated on and agreed upon by the buyer and the seller, it must be written in an agreement and signed by both parties. And buyer and seller must both complete IRS Form 8594 and attach it to the tax returns in the year of the sale. What this does is it tells the IRS how the two parties have agreed to the allocation of the purchase price, since, as we explained, the tax allocations are different and the tax rates are different for those various components. And now a little bit about payment terms here. Most sellers are going to expect cash at closing. This means you'll need to have your bank financing ready to go and teed up. Practice loans are often structured as a 7-year or a 10-year term loan. And we also suggest you consider getting a working capital line of credit to help provide money for the business as you get it up and running. It can also help act as a safety net in case cash is ever tight at any point, or if you need to use it to buy some equipment down the road. There are members out there who are known for financing dental practices, and you as a buyer will find it really helpful to work with a bank and bankers who finance dental practice transitions before. And we've seen too that loan packages and interest rates offered will vary by bank, so it does pay to get a couple of financing quotes and to check your options. Practice purchase, you may have agreed to buy the existing practice's accounts receivable. Sometimes this is a good point, as it does help provide cash flow early on in the practice when you've taken it over. Also, going to the bank for financing, there are some situations where sellers may consider financing part or all of the deal themselves, as it may be more tax advantageous to them to do so. Now a bit on employing the selling dentist. The key question here, as you can see illustrated in the graphic that we like to call the practice profit pie, the key is whether there's enough production and practice profit available to pay a selling dentist for his or her work, and the clinic with enough profit to pay back your purchase loans, and paying yourself a fair and reasonable rate and you need to cover your living expenses. This may depend on the specifics of the practice and your terms and your personal expenses. So it's something that your CPA or advisor can help you figure out in this process. Also seen in practice that short transition times can work. For example, you close on the dental practice on Friday afternoon and you're the one that starts seeing your new patients on Monday morning. Patients are going to leave if the first patient experience is a positive one. Plus about it, as the patients come into your practice, they're going to be greeted by the familiar faces of the front desk and hygiene staff that they've known over the years, and this is comforting for them. Matt, situations that make sense for a longer transition time?
There are, and a longer transition can work just as well as a shorter transition. Something of this is the start as an associate, move to owner model, where you come into the practice as an associate working for the owner, but on agreement where the owner has agreed to sell you the practice at either a set price or a set method to value the practice at a certain date in the future. So you have an agreement in place that you're going to start an associate now to get used to the practice, get comfortable with it, and you're going to buy it from the current owner 2 years from now. Or there may be some sort of a role reversal after that 2 year where you become the owner and an old owner stays on as an associate working for you. A sale is also possible if the practice is right and in the right circumstances, where you come in on one as a 50% owner and the current owner remains as a 50% owner, and the two of you own the practice together. And that work again if the profit in the practice is big enough to support both of you in the practice at the levels that you think are reasonable. With either of these situations, you really want to watch out for the details and plan for the details up front and have an agreement in place about how the practice is going to be valued when you either buy in or buy the second half, what the time frame is for that, if there's a set certain date for that. You're going to buy part of the goodwill from the current owner right now today. You want to define in that agreement how the goodwill is being transferred, so how those patients that relate to your goodwill are getting transferred to you, and if there's sort of a cap on or patient number for the existing owner. Factors to thought when you're thinking about how long should you employ the current owner. It might boil down to simple questions like, can you handle all of the patients that are currently in the practice, or is that just too big a patient load for you to handle by yourself? Do you need somebody else to be there? Can you have production by yourself? Can you do all the services that the current owner is providing? If they're doing some ortho work, can you do that ortho work too? And are you to take on the management responsibilities of the practice? Are you ready to be the business person in charge of the practice, or do you want some help transitioning into that role? You also want to think about some physical constraints there, physical space constraints. Is the practice literally big enough for the two of you to practice in, or tripping over each other? And then, emotionally, are you ready to practice with that person? And, there are people to buy a practice from that might not be a great person to work next to for the next couple of years. And you want to make personalities are going to be a mesh before you agree to be a co-owner of a practice with somebody.
And 50-50 means
50-50, yeah.
Equal votes, right.
So those are the big things to think about there. When you've decided whether or not you want to employ that owner going forward, that gets more into the due diligence process for the buyer. What's that going to look like for a buyer, Laura?
It's really the time to dive deep into the information of the practice so you can give a full evaluation on whether or not this is a practice you want to buy. And what we see information requests is practice financial statements and tax returns for at least 3 years, sometimes up to 5, if not more. A deep dive on insurance contracts, learning who the practice is contracted with, because you're going to want to take over those contracts or at least strongly consider it, and what kind of reimbursement rates are they providing. And also, what does the lease agreement look like? Does it have a favorable long-term rate, or is it something that you're going to end up needing to negotiate in the first year or two after the practice transitions? You're going to want to look at some chart reviews and just see what kind of dentistry the doctor was providing to the patients, review the patient information, and also consider the employees. What are their positions? Are they staying busy enough? What are their pay and benefits? Ideally, you're going to keep those employees on to help transition the practice when you take over from the hiring dentist. A couple other to consider in this process is the communication to patients. Typically see is that this is agreed upon in writing before the deal closes. Both selling doctor and you as the buying doctor or the new owner would agree upon the kind of communication that's out to the current patient base about the transition of the practice and also introduction of the new dentist to the patients. And then mention those post-owner agreements to consider, particularly if you're going to employ a dentist beyond the transition date, what does that employment agreement look like? And then also you're going to want to consider having a covenant not to compete so that dentists that just sold you the practice can open up shops down the street within a certain time frame. Or perhaps they're going to stay on and give you some advice from time to time, and that makes sense in terms of getting a consulting agreement in order. We're going to wrap up by talking a little bit about the team that you're going to need as a buyer. You're going to want to work with an attorney who has helped transition dental practices before so that they can give you good advice and have an idea of what these documents should look like. You're going to want a good accountant or CPA or advisor to help you through this process as well. And if you're purchasing, since often financing is involved, you're going to want a good lender, a good bank that works with dental practices to help you be part of this. I think the key thing really here from your buyer's perspective is you want people that are ingrained in the dental industry to help you through all of this. It'll save a lot of headache going forward. And thus into the question and answer session. Did we get some questions coming in?
We did. We had a few really good ones. Again, if you have a question, please be sure to enter it in the chat feature of the screen, and we will answer your question. First of all, we received a question. When you were talking about valuation, you had mentioned 70% of collections. So the question is, are you seeing 70% of collections for the value as a whole in the Madison area, or does that also include rural areas in the state?
Great. That 70% number we're seeing, that that's where we picked out of the range we're typically seeing. And we're seeing practices trade hands for anywhere between 65 and 100% of receipts, believe it or not. And he was than to use because the math worked out pretty easily for us without having to take off our shoes to count too. We're not seeing prices a little bit lower in rural areas, but not significantly lower. I think it's the other factors that Laura went through in the presentation that are really determining where in that range you fall on the price. Is it in a great location? Is it an up-to-date building with great equipment? And some of those factors are more important than is it in Madison or Milwaukee or in an outlying community, whether you're at 65% or 100% of receipts on the price.
Our second question is regarding insurance contracts. Is low reimbursement to the seller good, bad, or neither for the buyer?
Laura, who does have to answer that.
You want to wrestle?
Yeah.
Okay. One more time.
Insurance contracts. Is low reimbursement to the seller good, bad, or neither for the buyer?
The buyer's perspective?
I think it was the buyer looking at a practice, and I thought their reimbursement rates were low. I'd want to do a little bit more homework into the practice to see if I could figure out why their reimbursement was low. Is it because we're locked in an insurance contract that just doesn't pay us very well? Or because our fees are set way too low in the practice, and we could potentially move that reimbursement rate up from the insurance provider by increasing our fees to more market level? And then depending on what the answer is to that question, we'll be able to tell you is it good, bad, or otherwise. If your reimbursement rate is low and it's because you're locked into an insurance contract, that might be bad because you might not have any opportunity to move it up or down and you might be stuck there. But it also could be a good thing if it's a low price, but it's drawing none of your patients into your practice.
Right.
There's certain circumstances where nobody likes a low reimbursement rate, but if a low reimbursement rate is keeping your practice busy and producing well on the bottom line because you're able to manage the other expenses in your practice well, it's not necessarily always bad news.
Lastly, and this is a really important question, I think, how do I identify practices for sale?
That is a question. There are practices for sale out there. It's always a moving target, but you've got a lot of options. The first being you could consider talking to your current employer and seeing if there is an opportunity for you to purchase into the practice. What are long-term plans, and are you or could you be a part of it someday? I think that's the first thing you would want to narrow out. If you like the location, if you like your area, if you're not planning on making a big change and if things are going well. But other ideas would be talking to your dental school placement office. They often know about clinics that are looking to transact. Or perhaps the WDA, they are a great resource. They often have practices listed for sale or positions on their website and in their publications. Perhaps if you're not looking in Wisconsin, check the ADA or check the state and local dental associations for that state. I'll talk with the supply reps that are in and out of your clinics. They are, around the area, checking in on dentists pretty frequently, and so they tend to have that inside scoop on who's looking to sell, who's looking to transition, not even public information. And then also check with your consultants, Matt and I at SVA. There are brokers out there that are wheeling and dealing practices as well. And then also look within your own network, your classmates and colleagues that you've gotten to know over the years. They might know of opportunities available as well.
Great, so much. We have come to the end of our half-an-hour webinar. Again, thank you, Matt. Thank you, Laura. If anyone has any further questions, their contact information is on the screen, and feel free to reach out to them. I hope everybody enjoyed the webinar today and have a very good day. Thank you.